It's that time of year again, folks. Yes, it's the holidays, but more importantly, it's tax planning time. We got a couple more weeks to take advantage of potentially the lowest tax brackets that we'll ever see. Are you prepared? Stick around. We will guide you to tax freedom and tackle your taxes. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president here at Peer Financial Advisors. And of course, the show's not the show without the big man. Welcome back.
It's good to be back. I miss Hawaii, but it's good to be back here in San Diego.
Yeah. We're talking about Big Al's favorite topic today, folks, taxes and tax planning. Reason why? $1.8 trillion is going to taxes. That's what the American people pay in taxes, $1.8 trillion. What can you do to save your money from Uncle Sam? Well, that's what it's all about. That's today's Financial Focus. Do you have your tax checklist? Are you looking at charity? Are you doing a Roth conversion? What about tax loss harvesting? Are you taking advantage of all of your retirement contributions? It's not too late, folks, to put some of these dollars back in your pocket. Let's break all this stuff down. Let's bring in the big man, the CPA himself, Alan Clopine.
All right, well, let's look at taxes for 2020. So what's changed? What's new? And that's one thing about taxes. We know they're always changing. Let's get into the tax brackets a little bit, because to understand tax planning, you have to understand how the tax brackets work. And then we want to get into some specific strategies, and maybe most importantly, at the end of the show, we'll get into last-minute tax planning techniques so that you end up paying less tax. So Joe, this is a timely topic, right? Everyone wants to save on taxes, and you know, there's the one constant of taxes is they're always changing.
Well, yeah, and then the other thing, Al, is that people wait until April. They get their taxes done, and they're like, oh, man, I should have done some planning. But like 95% of all tax planning needs to be done in the calendar year.
Has to happen before December 31st.
Absolutely. So let's dive into a few different things that's new. Is that we've covered this in the past, but the Secure Act, that's kind of this hidden act that everyone forgot about because of the pandemic. But a few slight changes here, and there could be a Secure Act 2.0 or the CARES Act 2.0 as well. But major changes when it comes to your retirement accounts is your required minimum distribution. That's a mandate by law that you have to take dollars from your retirement account. Was at 70 and a half. They moved that to age 72. So they pushed it out. There's rumors now that they could push that out to age 75. So a little bit of relief there for individuals that don't necessarily need to take that money, because that would help you in regards to your income taxes. For those of you that are still working later in life, you can still contribute to overall retirement accounts. So this is kind of a big deal, Al, because people are living a lot longer and the savings is not necessarily there. So being able to still contribute to retirement accounts was kind of a really good thing.
Yeah, it always seemed kind of odd, Joe, that at age 70 and a half, you could not contribute to an IRA anymore. And as we know, a lot of people are still working at that age, so it does make sense to extend that age. So I agree with that. That's a good one.
A couple of other things is that there's the elimination of the Stretch IRA. This was one of the biggest disappointments, I guess, in the whole act, is that when you have a retirement account and you pass away, prior, you were able to stretch out, or your life or your beneficiaries were able to stretch out that tax liability over their life expectancy. For instance, if a 10-year-old inherited your retirement account of $1 million, right? So they have a life expectancy of maybe another 80 years. So they would have to take 1/80th out of the overall account. The IRS says, wait a minute, retirement accounts are meant for retirement, not to pass wealth to the next generation. So now you have to distribute the dollars out of the account or close the account down within 10 years. So that's a pretty big deal, because instead of taking like 1/80th out, right, I got to take everything out in a 10-year time period.
Yeah, and Joe, what's interesting about that is you don't have to do it on a systematic basis. It's any way that you want to take it out. So in other words, you could take out nothing for 9 years and take out the full amount in year 10, or you can stagger it over time. So there is at least that flexibility.
Right, and some people still qualify, minor children, if the beneficiary is less than 10 years old, so or if there's chronic disease or an illness, things of that nature. So there was a little bit of relief. But this paid for the act itself, right? Because this is what's going to pay the IRS significant amount of money, because the sad news is that a lot of individuals don't have a lot of money in retirement accounts. But then there's this majority, or there's a small majority that has the majority of the retirement accounts. Those individuals are probably going to get hurt pretty bad because they have huge balances here and they're not necessarily spending at the speed of the required distribution. So when they pass those dollars off, they're going to get killed in taxes.
Yeah, and then Joe, late in March, that's when the CARES Act was signed. And the CARES Act, of course, was here because of COVID, because of the pandemic. And so a lot of us were hurting. So the first thing they did is they issued stimulus checks. I think it's $1,200, and many people got them, some didn't. But more importantly, at this point, there's still a couple things that you may be able to do. One is this CRD distribution. And that allows you to pull money out of your IRA if you qualify. And so if you had COVID, or your spouse had COVID, or if your income was reduced because of COVID, or your spouse's income was reduced from COVID, you qualify for this. So you can pull out up to $100,000 from your IRA, and you can pay the tax over 3 years. So it's a pretty good deal. Now, you can also, in 3 years, put the money back into the IRA and pay no tax whatsoever. So this is for 2020 only, so you've only got a couple weeks here to think about this. But realize, for many of you, it's a way to pull money out of your IRA and pay taxes slowly over time. There's no penalty, there's no 10% penalty for under 59.5. So for many of you, this could be a good strategy.
Yeah, without question. You could get fairly creative, but of course you have to qualify. But a lot of people are qualifying.
I think probably 80-90% of the people qualify in one way or another.
Yes, and so it's another way to get money out of these retirement accounts, and then you can spread that tax out. Or if you need the cash, of course, you can pay yourself back. Another thing that Al and I are getting questions on quite a bit because of end of year, and people are doing their tax projections. With the stimulus check that you did receive, that's a non-taxable event. So you don't include that as income because it's actually a tax credit for 2020. So if you did not qualify because your income was too high in 2019, but your income fell in 2020, you will be able to qualify for that tax credit. So for those of you that did get the stimulus check, it is not taxable income. It's actually a tax credit that they paid us a little bit early. So, all right, we're just getting started here, bud.
Yeah, we are.
We're giving away the tax planning checklist. We got a couple of more weeks. You got to check the boxes. Are you looking at everything possible to put more money back into your pocket versus Uncle Sam? Go to yourmoneyyourwealth.com. Click on that special offer. It's our gift to you, the tax planning checklist. Go to Your Money, Your Wealth. We're just getting started. We'll be back in just a second. Hey, welcome back to the show, folks. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. We're talking taxes again today. Imagine that. End of year tax planning tips, making sure that you check all your boxes. We got our tax planning checklist. You can go to yourmoneyyourwealth.com. Click on that. That's our holiday gift to you. Yourmoneyyourwealth.com. Click on that checklist and make sure you get it done. Let's go to the true-false question. Let's see how you guys did.
If I received an inherited IRA before January 1st, 2020, I can still use the Stretch IRA rules for the remainder of my life. That's a great true-false question, and the answer is true. And we've got that question a number of times. So in other words, if you inherited an IRA before 2020, you can still use the Stretch IRA rules for the rest of your life. You're 25, you can do the rest of your life. It's only if you inherit an IRA after January 1st of 2020.
Yeah, you don't have to recalculate your required distribution and say, oh, I got to get all this money out within the next 10 years. You just follow your same required distribution schedule if you've inherited a retirement account. For those of you that inherit a retirement account, you know exactly what we're talking about. For those of you that never inherited a retirement account, you're like, what the heck are you talking about? So let's move on. Let's talk taxes, Big Al. let's look at how the tax brackets work. Break this down for us, because people get confused on how much tax that they're actually paying.
Yeah, well, that's exactly right. So we have multiple tax brackets, starting with a 10% bracket, going all the way up to 37%. So what this is showing, and we're showing the married filing joint brackets here, what this is showing is that certain taxable income levels, this is after your itemized deduction, these are your tax rates. And the way this works is, let's say you're married and your income's $100,000. That means the first $19,750 is taxed at 10%. The next bit is taxed at 12%, and finally the last amount is taxed at 22%. So a lot of people think that once you go over into the next bracket, the whole thing is taxed at that higher bracket. That's not true. You get the lower brackets at every stage of the way.
Yeah, so you got to look at your taxable income versus gross income versus AGI and everything else. This is your taxable income. So this is after your deduction. So let's say you make that $105,000 in $25,000 is that you have for deductions, right? Then you're saying, all right, well, the first 19 or 20,000 is going to be taxed at 10. So just understand what your taxable income is. Then you can kind of see where you fall on this chart, and then you look at what percentage of your income is going to be taxed here, because this is really important when you start looking at end of year tax planning. We talk quite a bit about retirement accounts, IRAs, and 401ks, and the like, and there's a tax time bomb waiting for some of you that have built significant wealth there. So we look at Roth IRA conversions, because when you have taxable accounts, that's money in a brokerage account. And then when you have these tax-deferred accounts, that's your IRAs and 401ks. But a lot of you have very little money in a tax-free environment. So that's a Roth. So we've talked about, all right, converting money here. You have to get this done within the calendar year. So you only have a few weeks to do this. And tax rates, where do you think they're going to go? If I had a poll, if I polled all of you today, this morning, watching this program, how many of you think tax rates are going to go down? I would say very little of you would say that. So if you believe tax rates are going to go up, it might make sense to buy the tax rate today. Buy it cheap, because then you're buying the tax rate and moving those assets into a tax-free environment that will never, ever be taxed again. Ever, right? Did I make that clear? Never again. So what are some of the strategies that you might want to look at? Is just go to the top of your bracket. So we looked at taxable income, we looked at the tax brackets, and say, all right, well, here's my taxable income. I'm in the 22% tax bracket. How much money should I convert? How much money should I take from here and move it to here? All right, well, you just go to the top of that 24% tax bracket. So if I look at here, here's the top of the 24, that's $326,000, right? That's a pretty rich person. But in this example, it's like, all right, well, I'm going to go to the top of the bracket because I want to pay that 24% rate, because I know the 24% rate is going to 28. Would I rather pay 24 or 28? Of course you would rather pay 24. Buy the tax rate cheap. All right, we're going to pause here. We're going to switch gears a little bit. We got Peter Keller coming on board. Pete, welcome.
Thanks, Joe. Good to be back in the studio with you and Al.
Today I want to talk about a couple charitable donation strategies that I think a lot of people don't really know about. For example, there's something called a donor advised fund. You can actually give some of your assets or cash to this fund rather than a charity. So tell us how that works.
Yeah, so it's a very nice strategy. I think more people need to be aware of it. But basically, you can take an appreciated asset and set up an account called a donor advised fund. You take that asset and you put it into the donor advised fund, where you can then sell it, reallocate it, and then dole out to the various charitable organizations as you wish over time. Now, you can donate anything from cash to appreciated assets like stock or even real estate. So it's a wide variety of opportunity to donate into a donor advised fund.
Yeah, and I think one of the reasons you'd want to do that is you want to get a big tax deduction, maybe perhaps this year. Maybe you've got high income, maybe you're in a higher tax bracket, and you can put all those or bunch all those future contributions into 1 year. Particularly maybe if you're close to retiring and maybe next year you're going to be in a lower bracket, you get the deduction where it makes a lot of difference.
It's a great program. It's underutilized. I think more people need to become aware of it, but a donor advised fund strategy is an excellent strategy for charitable donations.
And I think to remember, if you have a charity that you want to give to directly, go for it. But this is if you want to put a bigger amount than you would give to a charity in a specific year. You take the deduction now and you dole it out later.
Yes.
Okay, let's talk about another one. Qualified Charitable Distribution, QCD. What is that?
Yeah, it's another fantastic strategy. And again, the idea is to reduce your taxable income with that. So after age 70, you have your required minimum distribution. You can use that and send it straight to a charitable organization, and that will reduce your taxable income.
Yeah, and of course the nice thing about that is doesn't show up as far as income or deduction, so it reduces your adjusted gross income because it goes directly to charity. And for people that are paying taxes on Social Security or facing other adjusted gross income limitations, it can be a real savings.
And again, another one that's underutilized, but it's out there available and should become more widely known. Fantastic strategy.
Yeah, and it can be used for your required minimum distribution, which doesn't even apply this year because you don't have to do an RMD this year, but it is a good strategy. So, Pete, thanks so much for coming in and talking with us.
Yeah, good to be back with you.
Hey, great stuff, Peter and Alan. End of year planning's right now, and if you want to give a gift, please do, and then just know that you will get a tax deduction as well. We got to take a short break. When we get back, we are going to wrap things up. We're going to ask the experts, but more importantly, go to yourmoneyyourwealth.com. Click on that special offer. It's our tax planning guide checklist. You got to check the boxes. We'll see you in just a second. The show's called Your Money Well. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, and Alan Clopine, he's the CPA. We're talking end-of-year tax planning. Go to yourmoneyyourwealth.com. Click on that tax planning guide. It's a checklist to make sure that you check the boxes so you don't miss anything before year end. Before we wrap up the show, let's see how you did on the true-false question.
The top 1% of U.S. earners pay about 37% of total individual income. Wow, can that be true? 1% of the people pay over a third of our taxes? That is a true statement. And for many of you, it's like, well, whatever, those are the 1%ers. I don't really care about them. But look at this graph that we have on screen, Joe, which shows that the top 50% actually pay almost all of our taxes.
Yeah, I don't think a lot of people realize that half of people don't pay any taxes at all.
Yeah.
And so with that, people get confused on what tax strategies is appropriate for them. You know what I mean? Because I think we've been told for years is that we'll be in a lower tax bracket once we get into retirement, right? Because you'll have less taxable income. But that's not necessarily, that's true for half the people or more than half the people. But people that enjoy this show, probably you're on the other half of that, where you might be in the same bracket or even higher depending on where your money's held. So making sure that you can do the things appropriate to save money in taxes is absolutely critical.
Yeah, Joe, so let's talk a little bit about year-end planning because we're at year-end. There's a few things that you can do to put yourself in a better spot right now. After December 31st, these things go away. So one is maximizing retirement contributions, and this is key if you're an employee, right? If you have a 401k or a 403b or something like that, you may want to maximize that out. Now, you may only have one more paycheck, so it's a little bit difficult. If you are self-employed, you can likely push that contribution into next year. So that is one of the few things, Joe, that can be done next year.
Yeah, I mean, with your 401k, 403b, you might have to put 100% of your check.
You may, to get any benefit, right?
Right, if you can do that.
Yeah.
But self-employed individuals or individual IRAs, you actually have until the tax filing deadline. So those are small nuances where you can still kind of procrastinate a little bit.
Yeah, exactly. Another one is what's called above the line charitable contributions. $250, it's not a big deal. Many of us don't itemize anymore because the standard deduction is so much higher. IRS is saying you can deduct $250 above the line. That's going to save a lot of money.
You know, let's talk a little bit about that because that was some significant changes within the Tax Cut and Jobs Act that was signed just a few years ago, where they doubled basically the standard deduction. So a lot of individuals and married couples don't itemize anymore. And like an itemized deduction would be medical expenses, charitable deductions, your mortgage. And then the big one was state taxes. And here in California, we pay a lot of state taxes. So that smushed it down to $10,000, like state and property taxes. So it's like, all right, well, I don't really have a lot to itemize, so I'm just going to take the standard deduction to make it easier, but it also hurt charities in some degree because people didn't necessarily feel that charitable deduction, so they came up with this and said, here, this is an above the line $250.
Yeah, it's better than nothing, right? But so for some people, and that's right, the standard deduction did double, and they limited the amount of taxes you can deduct. So for most people, unless you have a mortgage interest, you're not going to itemize in most cases. However, those that are charitably inclined, maybe they have the $10,000 in taxes, maybe they do $10,000 a year in mortgage, in charity. If they go ahead and make those normal contributions, then they won't get any benefit because the standard deduction is $25,000 for a married couple. So in other words, one of the strategies right now is to do what's called bunching, Joe, and that's where maybe you take your $10,000 of contributions and you deduct 20 in one year and none the next year so that you can actually get some benefit.
Bunching.
Bunching. I know that's your favorite strategy.
That's a bunching. Saves you $4. Let's go, folks. It's bunch. Let's switch gears here. Let's get some real smart people in here, or I guess that's still us. Ask the experts.
Why do I have to pay taxes on my mutual fund dividends if I reinvest them into the fund? It doesn't seem fair to pay taxes on money that I have received. This is from Miriam, Forest Ranch. I agree, Miriam. That really doesn't seem fair, but it is the rule. Because basically the IRS figures like you got the money and then you reinvested it back in the fund. That's just the way it goes.
Well, Miriam, just take the dividend then. You don't have to necessarily reinvest. If you have a dividend, that's income to you. You pay tax on that. You're just reinvesting those dividends and you're buying more share of the overall mutual fund. So it's not necessarily a bad deal, is that there's dividends that are produced by stocks. You can either take the dividend from the mutual fund if you choose to, or from the stock itself. But where the kicker comes in regards to mutual fund taxes, is that when the mutual fund itself loses value, right? And then you sell it at a loss and you still have a taxable event because of all the dividends and interest and everything, all the activity and the capital gains that happen inside the overall fund.
Yeah, that is true. And one more quick thing is if you do reinvest and you end up buying more shares, that becomes additional tax basis. So your future gain will be a little bit less. I had capital losses of $20,000 last year, but I couldn't use all the losses on my last year tax return. Can I carry those losses over to this year? Jim from San Marcos. Jim, actually, I got some good news. You can carry those losses over. IRS says that you can deduct capital losses against capital gains dollar for dollar. If you still have more losses, you can take $3,000 more against ordinary income. And if you still have losses after that, then you can carry that forward on your tax return indefinitely. So it's actually a pretty good deal. It's why, Joe, we tell people to intentionally do tax loss harvesting. Sell a loss, sell stock at a loss, create that loss, buy something similar so you're still in the market, but then you got that loss to net against other capital gains.
Yeah, it's a really good tax strategy, especially for those of you that are trying to create income or taking distributions from your account. Because if you have those losses that are built up, then you can start selling gains from your overall portfolio that has to be in a brokerage account, and that loss nets that gain dollar for dollar, so you can start creating some tax-free income. I mean, Al and I are huge fans of mitigating taxes as much as you can, and then just doing the simple things of just paying attention to your overall portfolio to make sure that you're taking advantage of this. Let's kind of wrap things up. Let's tackle your taxes. What did we learn today, folks? Well, what's new? There's a lot of things that are new, but guess what? What do you think next year, the following years are going to bring? Probably a lot more new tax legislation, so you got to make sure that you keep watching this show. Maximizing your brackets, Roth conversions, you still have time. Hopefully now you have a good basis or understanding of what we mean by putting money into a tax-free account. It's not like put the whole thing in there. Understanding where you fall on your tax bracket and maybe just maximize that bracket to keep it very simple. Really smart ways. Peter Keller and Al broke down some charity strategies, donor advised funds, things like that. Take advantage of that. Get that tax deduction this year. And of course, Al just broke down a few last minute strategies. That's it for us. Go to yourmoneyyourwealth.com. Click on the button for your tax checklist. It's end of year. It's a great gift. It's a gift that will keep on giving at least for the next couple of weeks. Make sure you check your boxes, get your tax planning done, and then have a wonderful end of this crazy, rotten year. That's it for Big L Clopine. I'm Joe Anderson. You just watched another wonderful episode of Your Money or Wealth. We'll see you next week.